Welcome back to one more insight update from the world of EV stocks. Before we begin, we've noticed that only a small percentage of our viewers are actually subscribed to our channel. We would therefore request you to subscribe to our channel so that you don't miss out on any of our future updates on NIO or the Tesla stock. Now, let's get started. Two of the most popular stocks on planet Earth right now are electric vehicle manufacturers NIO and Tesla. Together, they trade an astounding 200 million shares daily, thanks in large part to young individual investors hungry for a piece of the action. But these stocks are decidedly not the same. Tesla, which went public at a mere $17 a share more than 10 years ago, has been through the Wall Street ringer, while NIO made its debut in US markets a little more than 2 years ago. Tesla is US-based, with a cult-like following in American car culture and a highly popular CEO, while NIO is a Shanghai-based EV company that doesn't have the same amount of fireworks around its brand. Both picks have a lot of long-term potential as they are core players in the long-term growth of the electric vehicle market. But if one had to pick just one to purchase at current price and hold for all of 2021, our money would be on NIO over Tesla. Here's why we think so. NIO's recent secondary offering was well-timed and appropriate. Some investors called NIO's recent secondary offering in December as a blatant money grab to capitalize on its skyrocketing share price. We, however, ask, so what? Public markets fundamentally exist so companies can raise capital to keep growing, and the $2.6 billion windfall for NIO was the right move at the right time. Nobody held a gun to anyone's head and demanded they pay $39 a share. That was a fair price for a secondary offering. If you think NIO's supposed share dilution is a death knell, it's time to review the headlines from Tesla. Tesla is not shorthand for EV anymore. As an analyst at Roth Capital Partners said in November, Tesla is an umbrella stock that is tied to all other names in the sector. We don't dispute that statement, however we don't see it as a good thing for Tesla in the long term. While it certainly has a more direct link to electric vehicle adoption than a legacy automaker like Ford Motor, it is dangerous to think that more EV sales definitively means an ever-increasing market value for Tesla. Just as the tech bubble separated the powerhouses like Google from pretenders like theglobe.com, eventually markets will stop buying the trend and start looking at individual stocks. That could be dangerous for Tesla given its sky-high valuation. Tesla has a long way to go in China. Though much fanfare has been made about China-made Model 3 vehicles, Tesla only sold about 21,600 of the cars in November. That was good enough to be number 3 in market share in China, but certainly not the game changer. The Chinese market is crowded for Tesla, and competition is only going to get harder. NIO's growth, on the other hand, is for real, although from a smaller base. So far in 2020, NIO has admittedly only delivered 36,700 total vehicles. But that's more than 110% more than 2019's tally, and it's aggressively investing to keep production ramping higher. NIO targets to produce 7,500 cars a month by January 2021. While Tesla's China growth has to be taken as an extended part of an established multinational company operating in the US, NIO can capitalize on the China opportunity more directly. If you recall the early days of Tesla, the EV manufacturer sold people on the promise that 30,000 deliveries could become 300,000 in just a few years, and NIO appears to be tracking that growth plan as well. NIO has ties to state-owned allies. Like we reported in a separate video yesterday, NIO signed a new deal with State Grid Electric Vehicle Service Company, a part of China's massive state-owned utility. The plans are modest to jointly build only about 100 charging and EV service stations in 2021. But they show that NIO is doing what all successful Chinese stocks must do, which is to win favor with state-owned allies to continue growing its business and squeezing out competitors like Tesla. Meanwhile, Tesla's factory in Shanghai is 100% American-owned, and while Chinese banks provided the $1.4 billion loan for the facility, that's far different than a business partnership with partners in Beijing. NIO doesn't have Tesla's hype machine. There is no middle ground on Tesla. Right now, Goldman Sachs has a price target of $780 on the stock, while JP Morgan Chase has a price target of $90. Hedge fund icon Jim Chanos put it aptly on Bloomberg TV recently, saying Tesla is worth whatever people want to believe Elon Musk is touting. So, if an investor has a giant risk appetite or simply wants to own Tesla stocks for an eternity, it probably still makes sense. However, a matured investor knows that the potential upside in Tesla, with its current valuation of $600 billion, is getting smaller with each passing day. NIO, on the other hand, with its $40 billion valuation and a massive Chinese opportunity still ahead, has much further to grow in 2021. In more recent update from today, NIO moved up 6.15%, finishing at 43.34. Many investors who are watching the NIO stock closely are now believing that this could be the beginning of a fresh up move for the NIO stock.